radio and television. You've been very consistent in saying that the Fed would be raising interest rates and then holding them there for quite some time. Following today's decision, the markets have now priced in one more increase in May, and then every meeting the rest of this year, they're pricing in rate cuts. Are they getting this totally wrong from the Fed, or is there something different about the way you're looking at it, given that you're now thinking that moves might be appropriate as opposed to ongoing?
So we published an SEP today, as you will have seen, and it shows that basically participants expect relatively slow growth, gradual rebalancing of supply and demand in the labor market, with inflation moving down gradually. In that most likely case, if that happens, participants don't see rate cuts this year. They just don't. I would just say, as always, the path of the economy is uncertain, and policy is going to reflect what actually happens rather than what we write down in the SEP. But that's not our baseline expectation.
I just wanted to ask, with all the events of the past 2 weeks, do you still see a possibility of a soft landing for the U.S. economy?
It's too early to say really whether these events have had much of an effect. It's hard for me to see how they would have helped the possibility, but I guess I would just say it's too early to say whether there really have been changes in that. The question will be how long this period is sustained. The longer it's sustained, then the greater will be the likely declines in or tightening in credit standards, credit availability. So we'll just have to see. I do still think, though, that there's a pathway to that. I think that pathway still exists, and we're certainly trying to find it.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. Curious, how do you view financial conditions right now? If credit becomes expensive enough, choking off growth, as you said you're watching for, would that situation warrant a rate cut? What situation would warrant a rate cut? And have the bank failures prompted any discussion around changing the implementation of the balance sheet runoff? Thank you.
So we haven't really talked about changing the balance sheet implementation. That's not something we've discussed yet. As I mentioned, we're always willing to change that if we conclude that it's appropriate, but we're really not seeing any signs there. Sorry, then the question before that was, just give me a...
Curious how you view financial conditions now, and if credit were to tighten enough, if that would prompt a rate cut.
So, financial conditions seem to have tightened, and probably by more than the traditional indexes say, because the traditional indexes are focused a lot on rates and equities, and they don't necessarily capture lending conditions. So we think that, though. So there are other measures which if they're focused on, bank lending conditions and things like that, they show some more tightening. The question for us, though, is how significant will that be, and how, what will be the extent of it, and what will be the duration of it, and then once you know that, there's a fair amount of research about how that with broad uncertainty bands, how that works its way into the economy over what period of time. And so, so we'll be looking to see the first part of that, like how serious is this, and how does it look like it's going to be sustained? And if it is, it could easily have a significant macroeconomic effect, and we would factor that into our policy decisions.
Have confidence that there aren't other weaknesses out there in the banking system, given that this one got missed, as you noted.
So let me say what I think happened, and then I'll come to the questions around supervision. So at a basic level, Silicon Valley Bank management failed badly. They grew the bank very quickly. They exposed the bank to significant liquidity risk and interest rate risk, didn't hedge that risk. We now know that supervisors saw these risks and intervened. We know that the public saw all this. We know that SVB experienced an unprecedentedly rapid and massive bank run. So this is a very large group of connected depositors, concentrated group of connected depositors, in a very, very fast run, faster than the historical record would suggest. So for us, for our part, we're doing a review of supervision and regulation. My only interest is that we identify what went wrong here. How did this happen is the question. What went wrong? Try to find that. We will find that. and then make an assessment of what are the right policies to put in place so that it doesn't happen again, and then implement those policies. It would be inappropriate for me at this stage to offer my views on what the answers might be. I simply can't do that. Vice Chair Barr is leading this, and I think he's testifying next week. So, but that will be up to him. So that's really where it is. The review is going to be thorough and transparent. It is clear to your last question. It's clear that we do need to strengthen supervision and regulation. And I assume that there will be recommendations coming out of the report, and I plan on supporting them and supporting their implementation. Remember, we're looking, for purposes of our monetary policy tool, we're looking at what's happening among the banks and asking, is there going to be some tightening of credit conditions? And then we're thinking about that as effectively doing the same thing that rate hikes do. So in a way, that substitutes for rate hikes. So the key is we have to have policies got to be tight enough to bring inflation down to 2% over time. It doesn't all have to come from rate hikes. It can come from tighter credit conditions. So that we're looking at, and it's highly uncertain how long the situation will be sustained or how significant any of those effects would be. So we're just going to have to watch. In the meantime, and obviously at the end of the day, we will do enough to bring inflation down to 2%. No one should doubt that. In our SEP, each FOMC participant wrote down an appropriate path for the federal funds rate based on what that participant judges to be the most likely scenario going forward. If the economy evolves as projected, the median participant projects that the appropriate level of the federal funds rate will be 5.1% at the end of this year, 4.3% at the end of 2024, and 3.1% at the end of 2025. These are little changed from our December projections, reflecting offsetting factors. These projections are not a committee decision or plan. If the economy does not evolve as projected, the path for policy will adjust as appropriate to foster our maximum employment and price stability goals. We will continue to make our decisions meeting by meeting based on the totality of the incoming data and their implications for the outlook for economic activity and inflation. People think of QE and QT in different ways, so let me be clear about how I'm thinking about these recent developments. So the recent liquidity provision that has increased the size of our balance sheet, but the intent and the effects of it are very different from when we expand our balance sheet through purchases of longer-term securities. Large-scale purchases of long-term securities are really meant to alter the stance of policy by pushing up the price and down the rates, longer-term rates, which supports demand through channels we understand fairly well. The balance sheet expansion is really temporary lending to banks to meet those special liquidity demands created by the recent tensions. It's not intended to directly alter the stance of monetary policy. We do believe that it's working. It's having its intended effect of bolstering confidence in the banking system and thereby forestalling what might otherwise have been an abrupt and outsized tightening in financial conditions. So that's working. In terms of the distribution of reserves, we don't see ourselves as running into reserve shortages. We think that our program of allowing our balance sheet to run off predictably and passively is working. And of course, we're always prepared to change that if that changes, but we don't see any evidence that that's changed.
Bloomberg News. The minutes of the January-February meeting, the last meeting, indicate that you discussed the possibility of runs on non-bank financial institutions and the impact of large unrealized losses on bank portfolios. Can you talk a little bit more about that discussion, kind of what was talked about in light of that? And then why didn't the Fed, do anything about that at that point to ultimately prevent, what happened this month?
I mean, to be honest, I don't recall the specifics of that. It's quite an interesting 7 weeks, but I will tell you though that there have been presentations about interest rate risk. I mean, it's been in all the newspapers. It's not a surprise that there are institutions that have had unhedged long positions in long duration securities that have lost value as longer term rates have gone up due to our rate increases. So that's not a surprise. I think, as you know, as it is now on the public record, the supervisory team was apparently engaged very much engaged with the bank repeatedly and was escalating, but nonetheless, what happened happened. And so that's really the purpose of one way to think about the review that Vice Chair Barr is conducting, is to try to understand how that happened and try to understand how we can do better and what policies we need to change. I mean, one thing is the speed of I'll come back to that, the speed of the run. It's very different from what we've seen in the past, and it does kind of suggest that there's a need for possible regulatory and supervisory changes, just because supervision and regulation need to keep up with what's happening in the world. Good afternoon. Before discussing today's meeting, let me briefly address recent developments in the banking sector. In the past 2 weeks, serious difficulties at a small number of banks have emerged. History has shown that isolated banking problems, if left unaddressed, can undermine confidence in healthy banks and threaten the ability of the banking system as a whole to play its vital role in supporting the savings and credit needs of households and businesses. That is why, in response to these events, the Federal Reserve, working with the Treasury Department and the FDIC, took decisive actions to protect the U.S. economy and to strengthen public confidence in our banking system. These actions demonstrate that all depositors' savings in the banking system are safe. With the support of the Treasury, the Federal Reserve Board created the Bank Term Funding Program to ensure that banks that hold safe and liquid assets can, if needed, borrow reserves against those assets at par. This program, along with our long-standing discount window, is effectively meeting the unusual funding needs that some banks have faced and makes clear that ample liquidity in the system is available. Our banking system is sound and resilient with strong capital and liquidity. We will continue to closely monitor conditions in the banking system and are prepared to use all of our tools as needed to keep it safe and sound. In addition, we are committed to learning the lessons from this episode and to work to prevent events like this from happening again. Turning to the broader economy and monetary policy, inflation remains too high and the labor market continues to be very tight. My colleagues and I understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. The U.S. economy slowed significantly last year, with real GDP rising at a below-trend pace of 0.9%. Consumer spending appears to have picked up this quarter, although some of that strength may reflect the effects of swings in the weather across the turn of the year. In contrast, activity in the housing sector remains weak, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Committee participants generally expect subdued growth to continue. As shown in our summary of economic projections, the median projection for real GDP growth stands at just 0.4% this year and 1.2% next year, well below the median estimate of the longer-run normal growth rate. And nearly all participants see the risks to GDP growth as weighted to the downside. Yet the labor market remains extremely tight. Job gains have picked up in recent months, with employment rising by an average of 351,000 jobs per month over the last 3 months. The unemployment rate remained low in February at 3.6%. The labor force participation rate has edged up in recent months, and wage growth has shown some signs of easing. However, with job vacancies still very high, labor demand substantially exceeds the supply of available workers. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing upward pressures on wages and prices. The median unemployment rate projection in the SEP rises to 4.5% at the end of this year and 4.6% at the end of next year. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in January, total PCE prices rose 5.4%, excluding the volatile food and energy categories. Excluding those, core PCE prices rose 4.7%. In February, the 12-month change in the CPI came in at 6%, and the change in the core CPI was 5.5%. Inflation has moderated somewhat since the middle of last year, but the strength of these recent readings indicates that inflation pressures continue to run high. The median projection in the SEP for total PCE inflation is 3.3% for this year, 2.5% next year, and 2.1% in 2025. The process of getting inflation back down to 2% has a long way to go and is likely to be bumpy.
Welcome to the Crypto Teacher. And you know I come back with that video just to make you think.
Don't forget to like and subscribe to the channel.
And guys, we had Jerome Powell in the house today. And the only thing you could say is poor Jerome. Because when it came to SVB, he said they're investigating. But guys, we know the Fed knew exactly what was going to happen. And Jerome Powell stuck to the message like I told you he would. 2% inflation, and not done with raising rates, and they're going to continue on rolling off the balance sheet. And of course, guys, the mainstream media doesn't tell you the truth. They keep talking about, the Fed is going to pivot. The Fed is going to cut rates. The only reason why they backstop because they have to keep the sheep quiet long as they keep building the fourth industrial revolution. Guys, we know the go. Mainstream media is not going to tell you. They're not going to stop the mission. Yes, they're going to stop raising rates. I think they're going to do one more rate hike, but they're going to keep rates like it is for the rest of this year, so therefore it can kill off the economy. Guys, credit is chokeholding this economy. As long as they keep rates above 5%, it will do the work for them. They won't have to do anything. And of course, he was asked about the soft landing, and he said it was too early to tell. Guys, we're going in for a hard landing, and that's what they want. They want to lay off the masses so therefore they can bring in the machines, the robots, algorithms, and drones to take the economy over, pay each other with crypto, and the sheep are going inside the metaverse. But just like I stated, guys, they're going to keep the sheep quiet until they're ready to pull the rug. We can already see what's going on with China and Russia. If that wasn't a wake-up call, I don't know what else is going to wake you up. And on the same day, guys, we had Janet Yellen in front of Congress talking about the debt ceiling, and of course all this debt, and Biden wants to put over $4 trillion worth of taxes, and we know who that gets passed down to, the average working American. And remember, guys, I told you, Janet Yellen and Gary Gensler are the chess pieces to get us moved over to the fourth industrial revolution, and we're clearly seeing it. And remember, the crypto teacher told you, because he knows. When it comes to the New World Order, it's all planned out. You have a wonderful day.
Not sure exactly what you're suggesting here. President Biden has indicated that he is more than willing to discuss an appropriate path for spending and taxes and the overall deficit, that it's important to have a fiscally responsible budget plan, and that these are certainly appropriate matters for discussion between the White House and Democrats and Republicans in the Congress. Indeed. He looks forward to doing that, but not under the specter of destroying the country's economic and financial.
I think the specter that's being presented is a false choice. And the specter that you present does not have to be that. We are facing an unprecedented spending epidemic. We're in a deficit spending situation. We have $31 trillion of debt moving higher that we're parking on the backs and the shoulders of our children. If we don't address it in a responsible manner ourselves, the capital markets will address it eventually, and I think that'll be far more catastrophic. So we have to find a way to talk about this that doesn't pit ourselves with this doom and gloom scenario, and that we find a way to actually address the...
Senator Haggerty, President Biden has submitted to Congress a budget that has, over the next decade, $3 trillion of deficit reduction. It invests in our workforce, in our economy.
And it massively
ways
increases
that will
taxes at a time when we're
improve
trying to recover our
supply.
economy. It's a non-starter on both sides of the aisle, as you know, Madam Secretary. Let me get back to the questions that I wanted to entertain with you, though, today. As I mentioned in my opening statement, I've been tracking the Silicon Valley and Signature Bank situation in very close detail. The situation was caused by a remarkable set of failures, in particular the Silicon Valley Bank situation, failures of management, failures of Fed oversight, and failures of how we responded to it. Both President Biden and in your opening remarks just a few minutes ago, you unequivocally stated that no losses will be borne by the taxpayer for the actions that have been taken by the Fed, the Treasury, and the FDIC in guaranteeing that all insured deposits at Silicon Valley Bank and Signature Bank that followed the failed auction of SVB, that none of those will be borne by the taxpayer. I understand why that claim is politically appealing, but it's impossible to square with how these programs actually work. As you know, the systemic designation used in the guarantee of SVB and Signature Bank's deposits relies on the FDIC's Federal Deposit Insurance Fund, which will be replenished in the case of a loss with a special assessment on banks across the nation, which inevitably will be passed along to all bank customers, which last time I checked were American taxpayers. So as we saw with Signature Bank, the estimated cost to the Deposit Insurance Fund for this resolution alone is $2.5 billion, which will be paid for by fees assessed to banks across the nation. Is that correct?
There will be a special assessment too. So it's only an estimate, the $2.5 billion. We don't really know what the final cost
I understand.
will
I think
be, but there will be a special.
if you add SVB, it's going to become much larger. And when you increase the cost of doing business, that cost is going to get passed on to customers. So this number, $2.5 billion plus, and any future losses will be in fact borne by bank customers across the United States. Again, American taxpayers, the last time I checked. Is that correct?
Well, they may be borne by shareholders of the firms.
I think the fees tend to be passed on to the consumers. I'd like to turn to news reports yesterday that Treasury is considering whether the administration can order an unprecedented expansion of FDIC coverage to guarantee all uninsured deposits. As was reported, this facility would be backed by the Exchange Stabilization Fund, which was created to support the value of the U.S. dollar in international markets, not as a slush fund when consulting Congress may be inconvenient. I'm deeply concerned by these reports, as such a program would not only constitute a misuse of the ESF, but it would circumvent Congress's role in approving such an action. So, Madam Secretary, does insuring every deposit at every FDIC-insured bank in the nation over $250,000 require congressional approval?
This is not something that we have looked at. It's not something that we're considering. All that I have said is that when the failure of a bank is judged by supermajorities of the FDIC board, the Fed board, and myself in consultation with the president, when such a failure is deemed to create systemic risk, which I think of as the risk of a contagious bank run, that we are likely to invoke the systemic risk exception, which permits the FDIC to protect all depositors, and that would be a case-by-case determination.
I understand.
I have not considered or discussed anything having to do with blanket insurance or guarantees of all deposits.
2 points, Madam Secretary. One, I would encourage you, if you do consider something broader than the basic $250,000, to remind you that congressional approval is required of that in the form of a joint resolution. Two, the program that you just stated really suggests to many people in America, certainly people in my home state, that there's a two-tier system of insurance here in America. For those that are deemed to be systemically important at the time, and those that are not. I think many Tennessee banks are concerned that they would not be deemed
I would
systemically
disagree
important,
with
and that
that,
is
Senator
concerning.
Haggerty, and I said explicitly in remarks I gave yesterday to the American Bankers Association, which is mainly consists of community banks, that this is not a question of invoking it for large or medium-sized banks, only that the failure of a small bank, of a community bank, could likewise trigger a run on other banks and lead to the same judgment that the failure of that community bank creates
I think
systemic risk.
more clarity here would be
Going to a different economy, and we're going to be learning more about that as we go. But clearly, we're learning that things can be done from remote locations. We're learning that technology can replace people even more than we thought.
We're not going back to the same economy. We're recovering, but to a different economy, and it'll be one that is more leveraged to technology. And I worry that that is going to make it even more difficult than it was for many workers.
In Silicon Valley, and my friends who work in technology know that what we did to the manufacturing workers, we are now going to do to the retail workers, the call center workers, the fast food workers, the truck drivers, and then even bookkeepers, accountants, insurance agents, lawyers, and on through the economy. So what happened to the manufacturing workers is a very clear sign.
And so we'll import Chinese-based CBDC technology. So it's going to be CBDC in a box provided to you by the People's Bank of China.
Cryptoteacher and the New World Order book, plus the 3 kids books. It's time to re-educate. Also, new to cryptos, Coinbase, Bitrue, Binance. Do not forget book links and crypto links are in the description. The stock channel, guys. Don't forget to go like, subscribe, spread everywhere. You have your Kobo, your chip stocks, your banking, your gaming. While everybody's sitting at home, get home stocks, the Seaver, the biotech stocks. And while everybody's at home wishing they were still getting that free money, what are they doing? Drinking and smoking weed. Don't forget about those stocks, and you have a wonderful day. The most powerful person in the world is the storyteller. The storyteller sets the vision, values, and agenda of an entire generation to come. Steve Jobs. And guys, you know I truly believe in this. When you look at the New World Order, they're the storytellers. And that's the reason why I wrote my New World Order book. But guys, now it's time to change the current generation. And I wrote 3 kids books. You know I love the Trinity because I understand the power that's in it. So I have 3 books. We have an opportunity to change the generation, to educate. Not just me, but I want to show you that I take action on a daily basis. And I want you to take action on a daily basis. Whether it's your job, whether it's in your community, we have an opportunity right now to educate the masses. I posted this on my Twitter account. Please share, but this is a short clip of the 3 books. There's going to be a clothing line and action figures. Please get these books for your kids, nephews, cousins, friends, so therefore we can start the re-education now. Because as we see, the 4th Industrial Revolution foundation is definitely here. Robots, algorithms, drones, taking humanity out the picture. We have to re-educate. But let's get into the video.
Part 1. King Joshua and Drama Team save the village. Part 2. King Joshua and Drama Team save New York from COVID Stories 3. Part 3. King Joshua and Drama Team goes to China.
It's mandatory to get part 1, part 2, and part 3 of this series. It's time to re-educate Generation Z.